Silver investors. Everyone is talking about price, but almost nobody is talking about what high prices are starting to do to the supply side of this market. When silver explodes higher, it does not only attract speculators on screens, it also wakes up a very old, very real beast in the physical world: secondary supply. I am OG John AG. In this video, we will go deep into how today's high silver prices are pulling metal out of homes, workshops, and junkyards, why big players like Heraeus are warning about this surge in recycled supply, and why, even with this extra metal coming back into the system, the structural strain in silver does not simply disappear. Segment 1. High silver prices change human behavior. When silver is cheap, almost nobody bothers to sell old cutlery, damaged jewelry, or industrial scrap. It is not worth the time, the paperwork, or the emotional attachment. But when price pushes to high levels and holds there, everything changes. People start opening drawers, refiners start upgrading their lines, scrap dealers start calling old contacts. According to analysis reported by Kitco, Heraeus notes that high silver prices are now drawing in more secondary supply, that is metal coming from recycling and scrap, not from mines. This is not theory, this is behavior. When you see cash offers rise on the street, when pawn shops update their boards, when refiners see more old silver flowing in, that is secondary supply waking up because the price signal is loud enough. Segment 2. What secondary supply really is. Let us define this clearly. Primary supply is what comes from the ground, mining companies blasting rock, processing ore, delivering new silver into the market. Secondary supply is what comes from existing metal, old jewelry, silverware and decorative items, industrial scrap from electronics, solar, medical, and other sectors. Bullion that people decide to liquidate. Heraeus is pointing out that with silver at elevated levels, secondary supply is increasing. Why? Because for many people, the price is finally high enough to justify melting memories. Someone who ignored a bag of old silver forks at 20 or 30 is suddenly interested when values are multiples of that. Factories that used to stockpile offcuts and waste now find it profitable to recover every gram. Secondary supply is like a hidden mine inside the economy, and high prices switch that mine on. Segment 3. Why scrap flows do not mean the silver bull market is dead. Now here is the trap a lot of people fall into. They see headlines like, high silver prices draw secondary supply, and they think, okay, that is it. Recycling will flood the market. No more shortage. No more bull market. That is not how this works. First, secondary supply is temporary and reactive. Once you melt grandma's silver set, it cannot be melted again. Once a wave of hoarded scrap is sold, that buffer is gone. Second, the structural drivers behind silver demand are still there: solar and green energy, electronics, and 5G electric vehicles. Investment demand in a world of debt and currency debasement reports that examine the silver market in recent years continue to highlight repeated deficits. Years where total demand exceeded total supply, even with recycling included. Extra scrap can ease the pressure for a while, but it does not erase a deep long-term imbalance between what the world wants and what the system can sustainably deliver. So yes, secondary supply can slow a move, cap spikes, and give shorts ammunition, but it does not magically create endless metal out of thin air. Segment 4. How high prices trigger waves of selling. Let us walk through the psychology step by step. Stage 1. Price starts to run. Most people watch. Some people buy a little. Nobody sells big. Stage 2. Price makes headlines. Silver feels expensive. This is when the first big wave of cash-in behavior shows up. Jewelry owners think, I never wear this. Let me turn it into money. Families think, we need cash. These old pieces can go. Workshops think, if refiners are paying more, let us clean out storerooms. This is the wave Heraeus is describing when they talk about high prices drawing more secondary supply. Stage 3. That extra supply hits refiners and wholesalers. On paper, it looks like the market has more metal to work with. But here is the twist. You cannot repeat this wave forever. Once the easy scrap has been sold, the next wave requires deeper sacrifices. Heirlooms, strategic stock, industrial reserves that companies actually need. The higher the price goes, the more painful and meaningful each next round of secondary supply becomes. Segment 5. The industrial squeeze versus the scrap response. Right now, silver is pulled by two opposing forces. On one side, you have relentless industrial and technological demand. Solar, EVs, and modern electronics are not luxury habits. They are core to the infrastructure and energy transition plans of entire countries. On the other side, you have the scrap response to high prices. When price rises, more metal comes back from the past. But these forces are not equal. Industrial demand is a structural, long-term driver. Secondary supply is a short to medium-term reaction, heavily dependent on price spikes and human emotion. You can think of it like this. The industrial world is constantly digging a deeper hole in the ground with each new gigawatt of solar, each new EV line, each new factory upgrade. Secondary supply is someone throwing shovels of dirt back into that hole from old piles lying around. It helps. It slows the rate at which the hole deepens, but it does not fill it. Segment 6. What big players are actually telling you. When a major industrial refining group like Heraeus speaks, they are not just talking to day traders. In this recent analysis, they underline two things at once. Data around the economy and rates is messy. High silver prices are now drawing in more secondary supply. Most people stop at the second line. They hear more supply and think bearish. But professional readers ask a different question. Why do high prices have to pull in extra scrap in the first place? You do not need to wake up secondary supply if the market is already comfortably supplied. The fact that high prices are needed to coax old metal back into circulation is itself a sign that the underlying balance is tight. In other words, the system is whispering, we need more metal than mines alone are providing, so we are using price to drag it out of the shadows. That is not the picture of a lazy, oversupplied market. That is the picture of a market under tension. Segment 7. How to read this as a silver investor. If you are serious about silver, you cannot just watch candles on a chart. You must watch behavior. Rising secondary supply tells you that price has punched hard enough to make real people change their minds about holding metal. It confirms that the move so far was not just a paper fantasy. At the same time, you must recognize the limits. Scrap spikes are finite. They arrive in waves. They often coincide with moments of maximum psychological pressure, tops, panic, or euphoric selling. For a long-term stacker, this is how to think about it. Secondary supply may help cool off overheated rallies. It may give you better entry points when weak hands dump. It does not kill the long-term thesis in a world of deficits, rising industrial load, and fragile currencies. If anything, it proves the thesis. High prices are forcing the system to cannibalize its own past metal to keep up. Segment 8. The game behind the headlines. So next time you see the phrase, high silver prices draw secondary supply, in a professional report or a news headline, do not read it like a retail trader. Read it like someone who understands the full game. It means price has done enough damage to the old world of sleepy holders that they are now surrendering metal back to the system. It means recycling plants and refiners are busy. It means the invisible inventory above ground is being pulled out and transformed. And over time, as each cycle of high prices empties another layer of forgotten metal, the system becomes more dependent on mines that are struggling with costs and grades. New discoveries that are harder to find. A demand curve that is moving up, not down. This is not weakness. This is stress. You are watching a market that is slowly eating its own history to feed its future. You are OG John AG family. If you want to keep seeing the real silver story, not just the candles, but the hidden flows behind the price, make sure you like this video, share it with one friend who still thinks recycling will save the system, and subscribe with all notifications on. Because the next phase of this bull market will not just be about how high price can go, it will be about how much real metal is left when it gets there.